Airbnb bust is upon us, and some are calling for a housing market crash as a flood of short-term rentals are put up for sale. The big question is, how much of an actual risk is this for home prices? In today's video, I'm going to look at how many homes could hit the market if this theory is right, and what will be the impact to home prices. My name is Eric, and I'm a professional economist in addition to being a licensed real estate agent in the state of California, so I can bring you unique insights you'll be hard-pressed to find on other YouTube channels. Let's get into it. In my recent videos, I'm exploring scenarios under which we could see a full-blown crash to home prices of 30% or more. I've already considered the pent-up supply theory, which is the idea that a lot of homes that ordinarily would have come on the market but didn't due to high mortgage rates will come onto the market and cause a surge in housing inventory. I found that we could see a 6.3% decline in prices from this, but it's not enough to crash the market. Today I'm looking at the Airbnb bust theory, which is the idea that there were a lot of homes purchased as investments over the last few years and were put on the short-term rental market, which then saturated the short-term rental market and drove rental revenue to the point where the buyers will be forced to sell the property to stop the losses. To test this, we need to first get an estimate of how many home sales were purchased for the short-term rental market. Then we can look at the potential impact on prices. We don't have any solid data on this, so we're going to do a little bit of analytical gymnastics to get a rough estimate. Here's a graph of home sales over the last 10 years. Similar to what I did in my last supply surge video, I can add in a time trend that was calculated on the sales before the pandemic as a gauge of how many homes likely would have sold if the pandemic didn't happen. This area here below the time trend represents some pent-up supply that built up at the onset of the pandemic when the housing market was basically shut down. Now we have this area here above the time trend, which represents the buying spree that took place across the nation. Everything below it are sales that ordinarily would have taken place anyway. Some of these are a result of the pent-up supply coming onto the market, and some of them are homes that were purchased as investments for the short-term rental market. First, I'm going to subtract the pent-up supply from this area. I'm going to assume that the remainder is our rough estimate for how many homes were purchased for the short-term rental market. Now, some of these sales could have been from buyers who had been on the sidelines for quite some time and were taking advantage of the low mortgage rates at the time. So it is likely an estimate at the upper bound of how many homes could have been purchased for the short-term rental market, a sort of worst-case scenario. When I run all the calculations, I find an estimate of about 364,000 homes purchased for the short-term rental market during this time. This is far from precise, but since we don't have a more accurate data source to work with, this is our number. Now, to calculate the impact on prices, I'm going to assume that all of these 364,000 homes come onto the market. It's not likely that all these homes would come on the market at once. I'm just running a worst-case scenario here. I'm going to use my time series econometric model that I developed in my last housing supply surge video. And when I run the numbers, I find that the U.S. median home price could fall by 1.9%. A far cry from a full-blown housing crash, and not even as big of a decline that I found if all pent-up supply came online. Why isn't it a bigger price decline? For one, 364,000 homes coming onto the market just isn't that big of a deal. Before the pandemic, sales volumes were at around 500,000 each month. And like I highlighted in the pent-up supply video, there's a lot of pent-up demand that could absorb the increased inventory. But let's look at one last thing. In that last video, I estimated that there were about 2.3 million homes in our pent-up supply. What if we saw all those come on the market in addition to the short-term rental investments that went bad? That would be about 2.66 million. Running this new number through my model, I find that the median home price could decline by 6.8%. Again, this is a far cry from a full-blown housing market crash of 30% in prices. At this point, I think we can say that I busted the Airbnb bust theory. If we had a lot of short-term rentals come on the market, it would definitely put downward pressure on prices. The volume, however, just isn't big enough to move the overall market. Now, that's not to say that we couldn't see big price drops in regional markets. Some metropolitan areas like Phoenix, Arizona, and Austin, Texas saw a lot more homes purchased for the short-term rental market than others. So places like these could see greater price declines than the nation overall. But when we step back and look at it on the national level, the price decline just isn't that much. There's too much pent-up demand that can absorb an increase in market inventory. But what if something happens to demand, like an economic recession? That's going to be the topic for another video that's in the works. If you like these videos with original research in them, make sure you're subscribed and hit that notification bell down below so you know right away when my next video comes out. On this channel, I focus on forward-looking analysis for the U.S. and regional housing markets. I try to get out at least one video per week. If you found this video useful or at least mildly entertaining, go ahead and hit that like button down below, support the channel, and help it grow. Thanks for stopping by, and I'll see you in the next video.